So, SpaceX is going public. June 12th, 2026. Mark your calendars, hide your wallets. They're asking the market for a casual $1.75 trillion valuation. If you're keeping score at home, that makes it the biggest initial public offering in the history of human beings selling things they built. It's bigger than Saudi Aramco. It's bigger than Alibaba. It's practically the GDP of a medium-sized European country, all wrapped up in a shiny metal tube that occasionally explodes on purpose. Now, don't get me wrong. The rockets are undeniably cool. Landing a booster on a drone ship in the middle of the ocean? Awesome. The internet from space via Starlink? Also cool, especially if you live in the middle of nowhere and really need to stream Netflix. But there's a massive difference between a company that does cool, futuristic things and a company that is a safe, rational place to park your hard-earned retirement money. Because right now, if you peek under the hood, SpaceX's financials look a bit like a rocket that completely forgot to pack its parachutes. Let's look at the books. And I mean really look at them, not just the glossy PR brochures. In 2025, SpaceX brought in about $18.7 billion in revenue. That sounds great, right? Lots of money coming in the door. But here's the catch. They lost $4.9 billion doing it. Imagine running a lemonade stand where every time you sell a cup for $1, it costs you $1.25 to make it. You're doing a lot of business, but you're bleeding cash. And if you add up all the money they've lost since Elon first sketched a rocket on a napkin, they are in the hole for an accumulated deficit of $41.3 billion. Now, the defenders will say, but Amazon lost money for years. True, Amazon did. But Amazon was never valued at 90 times its annual revenue when it was bleeding cash. At $1.75 trillion, SpaceX is trading at a price-to-sales ratio of over 93. For context, Apple, Microsoft, and Nvidia, companies that actually print money and have profit margins that make bankers weep with joy, don't trade anywhere near that multiple. Independent analysts, like the folks at Morningstar who do this for a living, think SpaceX is worth maybe $780 billion. That's less than half of what they're asking for. So why the astronomical, reality-defying price tag? 2 letters. I. Earlier this year, in a move that surprised exactly no one paying attention, SpaceX merged with xAI, Elon's artificial intelligence company. The pitch to investors is a sci-fi dream. Space-based AI data centers, orbital computing, the ultimate tech monopoly. The reality? xAI burned through $6.4 billion last year from operations alone. They spent another $12.7 billion building data centers in Memphis. It's a business spending twice what it earns, strapped to a rocket company, and now they are passing the hat around asking you to foot the bill for the whole grand experiment. Let me put that in perspective for you. $6.4 billion in operational losses in a single year. That's roughly what it costs to run the entire New York City subway system. Except the subway actually moves people from point A to point B. xAI is still trying to figure out what its product even is. And those Memphis data centers? $12.7 billion to build server farms that compete with Google, Amazon, and Microsoft, companies that have been doing this for 20 years. It's like showing up to a Formula One race with a go-kart you built in your garage last weekend. Ambitious? Sure. Smart investment? That's a different question entirely. And here's the thing that really gets me. When you combine SpaceX and xAI into one publicly traded entity, you're not just buying a rocket company. You're buying a conglomerate of moonshot bets. Starlink is the only division that's actually close to profitability, bringing in about $7.5 billion a year in subscription revenue. But even Starlink needs constant satellite launches, constant maintenance, constant capital expenditure. It's a treadmill. A profitable treadmill, maybe, but a treadmill nonetheless. The Starship program, which is supposed to take humans to Mars. That's pure research and development spending with no revenue timeline. The government contracts are nice, about $4.2 billion from NASA and the Department of Defense, but those are fixed-price contracts. If SpaceX goes over budget, and they often do, they eat the loss. So when someone tells you SpaceX is worth $1.75 trillion, ask them, which part? The part that makes money, or the part that's a very expensive science experiment? Oh, and we can't forget the debt. We have to talk about the debt. Remember a few years ago when Elon bought Twitter? He took out roughly $13 billion in high-interest loans from major banks to make that happen. Well, through the magic of corporate restructuring, that debt eventually got rolled into the XAI and SpaceX ecosystem. So now, SpaceX is sitting on a staggering $29.1 billion of total debt. Their cash on hand is dropping fast. They are burning cash to build rockets, burning cash to build AI, and servicing billions in debt. They need this IPO. They don't just want to go public. They need your money to keep the lights on. And here is where the story stops being about billionaires in space and starts being about you, the everyday investor. You might be sitting there thinking, I don't buy individual stocks. I just buy boring, safe index funds for my 401k. I'm safe. Well, grab a helmet because the rules just changed. For decades, indexes like the S&P 500 and Nasdaq 100 had strict rules to protect you. A company had to be public for a year or show actual profits before being added. But Nasdaq just created a fast entry rule. Basically, if a company is big enough, and at 1.75 trillion, SpaceX is definitely big enough, it gets shoved into the Nasdaq 100 index just 15 days after its IPO. What does that mean in plain English? It means your passive index fund, the one you trust to slowly build your retirement, is going to be mechanically forced to buy SpaceX stock. Automatically, without asking your permission. And here's the kicker. To make room for this massive new addition, your fund will have to sell off proportional pieces of profitable, stable companies. They will literally sell your Apple, your Microsoft, your proven winners, to buy a company losing billions of dollars a year at a 93x revenue multiple. You are buying the hype by force. In the cold, cynical world of high finance, they have a term for this. They call it making you the exit liquidity. See, the venture capitalists, the guys at Andreessen Horowitz, Sequoia, Founders Fund, who invested in SpaceX a decade ago, they want to cash out. They've been riding this rocket privately for years, and now they want their billions in real money. But to sell billions of dollars of overpriced stock, they need someone to buy it. They need a giant pool of dumb money that buys no matter the price. Congratulations. Thanks to the new index rules, that someone is your retirement account. And just to make sure the insiders get out while the getting is good, SpaceX designed a special lockup structure. Normally, when a company goes public, insiders have to wait 180 days to sell their stock. It stops them from dumping it all at once and crashing the price. But SpaceX built a tiered system. Insiders can start dumping their shares as early as 70 days in. Think about that timing. Day 15, your index fund is forced to buy billions of dollars of stock, pushing the price up. Day 70, the insiders unlock their shares and sell them to you at that inflated price. It's a beautifully orchestrated wealth transfer. It's not illegal, but it sure is convenient for the guys in the top hats. Now, some of you might be thinking, okay, but what if it works? What if SpaceX actually becomes the dominant space and AI company? Won't I miss out? And look, that's a fair question. Nobody wants to be the person who said Amazon was overpriced in 1999. But here's what the what if it works crowd always forgets. You don't have to be early to make money. You can wait until a company actually proves it can generate profits, buy in at that point, and still make excellent returns. Warren Buffett didn't buy Apple until 2016, decades after it went public. He still made over $100 billion on that investment. Patience isn't just a virtue in investing, it's a superpower. The other thing to consider is concentration risk. Even if SpaceX succeeds wildly, do you want a single and profitable company to be one of the largest positions in your retirement account? That's not investing. That's gambling with extra steps. Diversification exists for a reason. It's the only free lunch in finance, as they say. And right now, the index fund system is about to force-feed you a very concentrated, very expensive bet, whether you like it or not. So the trap is set. What do you actually do about it? Wisdom isn't just about knowing you're being played. It's about knowing how to sidestep the game. Step 1. Become a detective of your own money. Check your portfolio. Log into your 401k or IRA. If you own a Nasdaq 100 fund, like QQQ or similar, you are going to be a SpaceX shareholder by July 2026. If you own a total market fund, you'll own it too, just a bit less of it. Knowing is half the battle. If you're 30 years old and decades from retirement, maybe you just shrug and ride it out. Over 30 years, markets correct themselves. But if you are 5 or 10 years away from retiring, you don't have decades to wait for an overpriced AI rocket company to figure out how to make a profit. You might want to look at funds that actually require companies to make money before buying them. Yes, they exist. They're called factor funds or dividend-focused funds or value indexes. These funds have rules. They look at a company and say, "Are you profitable? No? Then we aren't buying you, no matter how cool your rockets are." It takes a little more effort to find them, but it keeps your money out of the hype machine. Step 3, and this is the most important one. Do not panic, and do not let FOMO drive your decisions. The financial media is going to lose their minds over this IPO. CNBC will have countdown clocks. Your neighbor will brag about getting in early. There will be noise, hype, and hysteria. The wise investor sits quietly with their coffee while the chart zigzags behind them. You don't have to chase the rocket. You don't have to participate in the frenzy. You just have to protect your house. We live in an era where the lines between visionary technology and financial engineering are increasingly blurred. SpaceX is doing incredible things for humanity. But the SpaceX IPO is doing incredible things for venture capitalists at your expense. The wind of change is blowing hard in the markets right now. Just make sure you are the one setting your own sails and not letting someone else steer your retirement into a black hole.